Well, hello, everybody. We'll just give a minute or two. Thanks for joining the webinar, Real Bitcoin Returns with Two Prime and Copper. We'll just give a minute or two for people to enter in, and then we will kick it off. I'm here with, well, myself and Adam and Ben from Copper, but let's just wait 1 minute and then we'll get started. And Adam, where are you calling in from today? New York?
Yeah, I'm in New York. A little dreary day in New York. We can't seem to figure out our spring weather just yet.
And Ben out in London?
I am in London. Yeah, I'm in sunny Soho, so we're making the best of actually having some dry weather for the first time in about 3 months as well.
Okay, nice. Um, well, I think let's get started. Just to kick off, as mentioned, it's webinars with Two Prime and Copper Technologies. I'm Alex Blume, the founder and CEO of Two Prime. Two Prime is a Bitcoin financial services business focused on ways of generating returns on your Bitcoin, as well as one of the largest lenders of Bitcoin-backed loans. And we have a lot of opinions on what yield is, and I'll share them shortly. But Adam and Ben, do you guys want to give a quick intro to get started here?
Sure, absolutely. Good morning, Adam VandenBoogaard, Head of Revenue for the Americas at Copper. I've been with Copper for about 4 years now. Before joining Copper, spent time on the traditional finance side, on the equity prime brokerage desk over at Bank of America. So it's customer relationships across hedge funds, market makers, broker dealers. Excited to be here. Thanks for having us, Alex.
Thanks.
Great,
Ben?
and nice to meet everyone. Ben Thomas, thanks for joining. So I've been at Copper for about 3.5 years now. I lead our client solutions team, which manages all of our financing and collateral management products. Prior to this, a bit like Adam, I was on the prime broker side. I was over at Deutsche Bank in London, where I was a trader there for around 20 years.
Thanks, Ben. So we have about an hour today. We'll spend 20 minutes. I'll explain to you that Bitcoin yield doesn't exist at all. And then we'll break down, ways that you can actually make a return on Bitcoin and some of the risks and trade-offs involved with that. And then we'll turn it over to Adam and Ben to hear about how high quality infrastructure and technology on the back end can mitigate some of the risks involved with any kind of return generating activity. And then we'll open it up for 15 minutes or so of Q&A if there are any questions. You'll see as an attendee, there's a little box where you can ask questions and we'll address whatever we can at the end of the call. So with that, I will dive into our presentation, Real Bitcoin Returns. I'd say my background, Two Prime is a registered investment advisor. We're a commodity trading advisor. We're the branch office of a broker dealer. We work with, I think, 9 or 10 public companies that hold Bitcoin on the balance sheet and a lot of private businesses and kind of Bitcoin OGs, if you will, that have had thousands of Bitcoin for many years. And we've seen that market change a lot where people, the public space has become more competitive and the whole institutionalization of the whole industry has progressed. We've seen people more and more start to think about how do we generate a return on that Bitcoin? When Bitcoin was going up 5,000% per cycle, it wasn't so necessary to think about how do I make an extra 5% on this. But as the volatility and returns on Bitcoin start to diminish and it becomes more institutional, people are thinking about how do I generate a return? And then what we've seen is people calling this yield. And I take a lot of issue with that because I think yield has a very specific definition that we'll get into. But to start with, like the slide says, public companies and private ones have boards, and these people are saying, hey, you're sitting on $1 billion of Bitcoin or $5 billion of Bitcoin. It's just sitting there. You would never have like cash just sit in an account and do nothing. And so we've increasingly seen groups find ways to try to generate a return on that Bitcoin. And that is, I think, a reasonable thing to do. It's boards have pressures to grow businesses, individuals have financial needs, and it's great Bitcoin to hold it, but we also have to pay bills and we want to try to monetize things if it can be done with appropriate risk reward. To me, and I think in the financial world, yield, I guess you could talk about anything in yield of a numerator divided by a denominator, and you could calculate some yield number. However, in the financial sense, it's typically a treasury or a very high grade corporate bond, things where you're getting paid effectively for the time value of money. You're saying, I'm going to lock up money here so you can use it, and I'm going to get paid some predictable rate. I'm not taking risk of counterparty or credit risk or trading risks. Um, I'm not taking equity bets. I'm not betting on the management team. That to me, and I think in most of finance, is the definition of yield. Um, so within Bitcoin, I think that we think that yield can exist and we can get these moderate returns, maybe 3, 5, 7% with 0% drawdown, with zero volatility, and you'll never lose any of your Bitcoin. And it just simply does not exist. What you can do is you can take risks and get paid a return. And there are better risks and worse risks. And I would say, I think about what's the risk-free rate on Bitcoin. Well, if you want to hold it with a qualified custodian like Copper, it's actually, or which I think is the right thing to do. And I'm sorry, you guys aren't a qualified custodian yet, but they're on their way. Or if you want to hold it with other qualified custodians or any custodian, you're going to pay a fee. And then if you want to be able to actively trade it, that fee is higher. And then if you want to hire a manager like Two Prime to grow it in a responsible, predictable way, there's another fee. And so the risk fee rate of trying to actually generate a return on your Bitcoin is probably like -2% or something. That's what it costs just to be in the game. So anything beyond that is based upon taking risk, which it's not bad to take risk. It's just bad if you don't know what you're getting involved with. So let's first talk about the MicroStrategy or strategy method of yield, which is they have a stock trading at 50% above the value of the Bitcoin they hold. They sell that stock and they buy Bitcoin. And so effectively you're giving them $1.50 and you're getting $1 worth of Bitcoin exposure. And then if you're already in, you're getting Bitcoin exposure and your Bitcoin per share or the amount of Bitcoin that you can assign to your shares, you can say has gone up. The numerator divided by the denominator has changed. However, you've taken $1.50, you've moved it to $1, and now as you approach back towards $1.50, you're saying, hey, I've generated a yield. But if your goal is just to accumulate Bitcoin, you could have just started with the $1.50 of Bitcoin in the first place. And the way this becomes insidious is that even if the Bitcoin per share is going up, the stock price can collapse as that multiple to NAV compresses. And so, okay, great, I have more Bitcoin per share, but I've lost 30% in dollar terms. I don't think that's what most people want, or it wouldn't be the most efficient way to accumulate Bitcoin per share. And so, yeah, I think that this is almost every possible risk you can take. You have actively managed risk. It's regulated by the government. It can be seized by the government. If Michael Saylor dies, like who knows what would happen to this strategy stock? The policy of issuing shares can change. There's so many unknowns. The regulatory regime can change. There's so many unknowns. There's new competition entering that if your goal is just predictable yield, this is probably one of the last ways you would do it. If your goal is actively managed risk with a competent management team, it maybe makes sense. Probably if you're especially focused on generating dollars. But this is not, in most people's sense of the word, what I would call yield. What you can do is get a return. Like you could get a profit paid to you for taking risk. To us, most of our clients, they want to accumulate more Bitcoin and they want to take very, very little risk in getting it. And so to us, like it's like Fight Club. Like all the rules are don't lose people's Bitcoin, and if you can make some on top of that, that's great. We have clients that their goal is to generate 2% more Bitcoin per year, but they want near zero drawdown. You have to be able to suffer at least some kind of drawdown to generate a return, and those drawdowns could be black swan kind of events where you lose all your Bitcoin at once in improbable events, or it could be low volatility drawdowns that occur more frequently. But one way or another, if your goal is not to lose Bitcoin, which makes sense, you should understand the risks that you're taking. So now that we understand yield doesn't really exist, there's just risk taking. We can look at different ways people take those risks. There's, Delta One or basically leverage strategies, very similar, but you can buy futures and basically amplify the beta of Bitcoin. So you can go up faster than Bitcoin or go down. There's also levered ETF products that achieve something similar with a bit more fee on top of it. You can do DeFi staking. So there's platforms like Babylon where you can get paid some other coin that I think right now the Babylon yield is 4 bips per year. It's gone down. It was higher before. There's other platforms like Stacks and others. Again, these have a history, not these specific ones, but some have a history of major black swan events where you lose all your Bitcoin very quickly. You could sell covered calls, which um, is a strategy that's easy to understand. You get paid a premium to be short Bitcoin on the tail to the upside. And most of the time it works, but sometimes it doesn't. You can lend Bitcoin to somebody else and just hope that they give it back to you at some point. Depending on the counterparty, that could be a really reasonable idea or a very bad idea. I remember when BlockFi went out of business, BlockFi seemed like the biggest possible juggernaut in this industry, and they were gone. And so sometimes what feels like a safe counterparty is not always the case. And you can leverage, I think, is very similar to Delta One, and then derivatives. You can, to fully expose our bias, my firm primarily focuses on trading derivatives, and so that's our what we think, to be clear, is the best risk reward you can take. However, there's still risk in that, and there's stupid ways to trade derivatives. There's smart ways to trade it, but there's ways to even trade derivatives across different exchanges or different products on the same exchange that you can get paid for arbitrage, basically providing liquidity across two different places with very predictable and containable risk. Like I said, most of the groups we work with, they want a 5% return. They want very low beta, very low vol, low correlation, and they don't want to lose their Bitcoin. And so the idea is this should be an all-weather strategy that produces a return, regardless if the price of Bitcoin goes up or down or stays flat. And especially as the market has grown more institutional, it may sound like a simple thing to do. It's a very difficult thing to do with an asset that really doesn't have that long of a track record. And even within its track record, I think we're really in a whole new phase of the way it's behaving that has departed from past historic models over the last year, especially. Things like implied volatility or realized vol have massively changed. So this is a hard thing to do, but it is a reasonable thing to want. So let's talk about unsecured lending. As I mentioned, Genesis, BlockFi, Celsius, these were huge firms that disappeared overnight. And so you were making a 3-6% return, and then you lost 100% of your Bitcoin, or my mom, it took her like 3 years to get back some cash for the Bitcoin she had at BlockFi. And she didn't feel like it was a good trade. And so, I think that the challenge is that there's only so many good counterparties in what is a relatively small industry. And so there's a lot of risk here. Another one where there's a lot of risk is covered calls. And so, when you sell a covered call, you're going to generate, depends how close to the money you sell it, but you generate 1-2% per month. And it's going to work every single month, especially it's worked well over the last 9 months as Bitcoin's fallen and fallen. You're not hitting that upside. And then all of a sudden, Bitcoin rallies 10, 20, 30% in a month, and you can lose 20, 30, 40% of all of your Bitcoin in a single trade in a single month. There's ways to actively manage Bitcoin to these covered call strategies to mitigate some of that, but it's still a risk. And I think this one's particularly insidious because it can appear like, oh, this works for a year. I've been making money every year. This is so easy and simple. And it can kind of lull you into a sense of safety, or you start putting bigger bets on, and then all your Bitcoin's gone really quickly. And again, it's like, was it worth it to make 6% on your Bitcoin to lose 30 in a week? The thing with Bitcoin, with a very high vol asset, 50, 60 vol asset, is it's almost a certainty that this is going to happen if you stay in this product long enough. This is, a graph of covered call and strategies over time. You could see gradual accumulation and then a collapse, and then a collapse, and then a collapse, and then a collapse. And so depends on how far back you look, but if you enter at the wrong time, it could be a very painful experience for what appeared to be a very straightforward and simple strategy. Another thing to note is just that over especially the last year, once the ETFs were introduced, things like implied volatility and basis trade on Bitcoin have shrunk from when we first started trading Bitcoin options. Implied vol was 150, and now it's sat in the 30s for the last year, which is still a pretty high vol asset, but nothing like 150. The same on basis trade. When we started trading futures, you could get 15-20% of a delta neutral. In terms of trades, it's one of the most risk-free trades available. And that has shrunk to now it's like 3%. It's below even what a treasury pays. So You're taking exchange risk. You're taking risk with this new financial product. You're paying taxes, cap gains taxes, and you're ending up at best with 3 or 4%. Probably not as attractive as it used to be. As mentioned, DeFi, again, you can get persistent returns. They have streamed to you. They'll come to you every hour in some cases. And then, like we saw this last week, there's just so much mess in DeFi. A lot of it isn't really decentralized anyway. There's kind of a move fast and break things approach that, there's products that work. But at least for me, I don't want to sit around auditing the code of these DeFi products to decide which one's going to suffer a massive hack and gets logged in lawsuits and try to get their money back from North Korea and which ones don't. And the thing is, even the auditors that audit these things and get paid six figures to do it, they don't seem to be that good at figuring out which ones are going to blow up either. And so there's just reasons that for centuries the financial system has been created the way it has with the rules and protections it has, which can feel like very slow and old, and they are in many ways, but they do protect people. Like we said, lending is a terrible idea. And so the main conclusion here is just to say, if you want these things, you're making a trade-off. If you want full principal protection, there's nothing you can do possible. If you want low vol, you have to accept that you're trading some kind of long tail risk that could produce a black swan event. If you want low beta, you have to accept that you're either taking some kind of counterparty risk or making trades that don't respond to the market. On and on, there's risks that you're taking. So, like I said, we kind of ran through this already, but what can you do? Unsecured lending. It depends who you're lending to. Like if you're lending to BlackRock, I feel pretty good about that. It's not impossible that they might fail on their debts, but it is low probability. The problem is there's not that many BlackRocks, and BlackRocks or Galaxy, these groups can borrow from pretty much anybody they want. They can get the lowest possible rates, and they still have a capacity constraint. Like they don't want unlimited Bitcoin, and there's a lot of Bitcoin looking for a place to go. And so you can start getting higher rates and more capacity to lend unsecured, but you're going further and further out on counterparty quality. And the scary thing is, like, you can give it to a market making firm. You have no idea what they're doing with it, what the risks are being taken. They may be in DeFi stuff you didn't want exposure to in the first place. And suddenly you wake up and your money's gone, and you didn't even know, like you were in some protocol, looped on some protocol, and all of a sudden your Bitcoin's gone. Another thing you could do is borrow dollars against your Bitcoin and then use those dollars to generate some kind of arbitrage or return. Right now, borrowing rates are quite low. If you borrow on DeFi, as long as your money doesn't disappear, there's rates as low as 4%. In more traditional, just TradFi lending, like what we do, it's somewhere in the 6 to 9%. And then in retail TradFi lending, it's in the double digits. And so then you're borrowing dollars, you're putting into some other strategy, and then you're capturing a difference. So let's say you borrowed 5% and you're making 10%, but you're only borrowing 2/3, 50% to 2/3 of the Bitcoin is in cash. So you're making 5% on 50% of your money. So you're really making 2.5% on your actual Bitcoin. And you've added like 8 layers of risk. I don't know if that's worth it. It may be if you have some amazing dollar generating thing you can arbitrage, perhaps. It also really depends who you're borrowing, your lending counterparty is. And then, if you don't have more Bitcoin, if the price of Bitcoin falls and you can't meet a margin call, all your Bitcoin can be sold to cover the principal that was lent to you. So some risks there. And again, like these are reasonable risks if you know what you're doing, but there's a lot of them in here. What we covered calls, I think we covered that pretty thoroughly, but you're going to earn a persistent premium, even though that premium is going down over time. And then you're going to potentially have a tail risk or volatility event where you lose a lot very quickly. And then, of course, the solution to everything, which is delta neutral arbitrage on derivatives. But for us, we look at trading across different exchanges, and you could trade being the exact same product and earn a funding rate between perps on two different exchanges and just manage liquidity across them. Or you could trade things like perpetual futures against dated futures, and they behave in different ways. They go up and down a little slightly differently, and they cost different amounts because they're used for different things, but they're delta neutral in the sense that you can be on both sides of a product and it won't be affected by the price of Bitcoin directly. And then if you use a platform like Copper, you can obviate the exchange risk and keep it off exchange with Copper as long as you think Copper's not going to lose the money, which they have so far done a good job for us. Um, so we feel like that's the best thing is I can have arbitrage where, yes, you can lose money through arbitrage, but you can contain that loss to something that's knowable. It doesn't happen like a sudden black swan event. It happens like, oh, the funding rate has shifted between these two things and it's not worth it anymore. There's some trading costs. But if you can bridge these gaps of what is still a very fractured market, there are ways to create predictable, knowable returns, which are not yield, that work over time. They don't last forever, but they do offer a lot more low vol, predictable risk than almost anything that is available. So in conclusion, I think a lot of people are saying, a lot of people go, what's the headline yield number? Or how much am I going to make? Or who else does this? And I think those are not the right questions to ask. The question should be, is this risk worth the reward? What is the worst case scenario? And who cares who else is doing it? Smart people do dumb stuff all the time. Things that are popular. I remember when Terra Luna crashed, everyone was rushing into this thing. It seemed like the best thing ever, and it turned out it wasn't. And so I would really do your own research. If you don't understand what you're getting involved with, it's not worth it. Like if you really think Bitcoin's going to $1 million a Bitcoin, what are you really willing to risk? If it's not super knowable, it should be very strict. And so, I think in the future, it's just more professionalism, having clarity around exactly to the detail where you lose and gain on a trade, understanding what you do in cases where the trade isn't going well, and understand labeling things correctly. None of these things are yield. They're risk-on strategies that make a return. So with that, I will cede my time over to Adam and Ben, who are going to tell you how they can stop you from catastrophic loss of your Bitcoin. So take it away, Adam and Ben.
Awesome. Thanks, Alex. Appreciate it. So Adam VandenBoogaard, Head of Revenue for the Americas at Copper. Very happy to tie that into, I think, what underpins and helps support from a tech infrastructure perspective, all of the strategies that you just described. So our side, I think, is certainly the much less sexy side. That's why we're Copper, right? We're the plumbing, we're the piping, we're the network and infrastructure layer that I think helps make all of what Alice just described work. So hopefully a good segue into, I think, our role of providing safety, security, counterparty risk mitigation, which Alex highlighted, and certainly the capital efficiency side of things. So I think, simply put, Copper can be described as a financial markets infrastructure firm. We've been operating globally since 2018. We provide institutional grade custodial services for digital assets, our digital asset off-exchange settlement service known as Clearloop, and then some additional kind of value-add services, including access to staking, agency lending, OTC trading, all through our Swiss desk. And Ben will describe that here in just a couple of minutes. That's all offered across a secure and scalable platform, really designed to help customers reduce that counterparty risk and move capital efficiently. We support about 50 different blockchains. We have connectivity to about 40 different centralized exchanges and offices, around the globe, which really enables that 24/7, 365, follow the sun kind of white glove service model. So I think maybe helpful to take a quick step back and offer a little bit of a quick primer on kind of the evolution of institutional custody from hardware security module to multi-sig to multi-party computation, or MPC technology. We've seen the digital asset custody ecosystem progress pretty quickly from kind of simple self-managed key storage into much more sophisticated kind of institutional grade infrastructure. Some of that early custody relied a lot on some manual methods, some basic software, and with it came some pretty significant operational risk. I think the custody space today has evolved into really kind of an integrated ecosystem that combines some aspects of self-custody, some aspects of regulated third-party custody, and certainly a lot more advanced models of technology using MPC as kind of the basis. I think that evolution is a little bit of it's a story of reducing single points of failure and doing things like increasing flexibility, scalability, and security all within kind of the custody world. So where we started on the HSM side of things, you can kind of think of that as putting a private key inside a tamper-resistant hardware box. The problem is that private key still exists as a single key inside the device. So there's some trouble and some challenges associated with scaling that across geographies, Workflows can be difficult. You have the physical hardware dependencies that creates various operational bottlenecks. Obviously, you can't run a high frequency trading strategy if you have to retrieve a USB from a hardened bunker. So HSMs secured keys well, but they didn't solve that kind of single key, single point of failure problem. So you have then kind of along comes this multi-sig idea where we start to split control across multiple different independent keys that require some sort of a threshold, for example, a 2 of 3 in order to sign. The problem with multi-sig is it became, I think, largely protocol dependent. So Bitcoin, Ethereum, each asset handled multi-sig a little bit differently. So it was hard to upgrade, hard to migrate. So while multi-sig introduced some of that kind of distributed trust idea to the space, it really lacked some of the flexibility and kind of universal compatibility that the institutional focused kind of participants needed. So what MPC does, kind of in contrast to that, is it eliminates the idea that one private key controls access to your digital assets. So instead, it splits that key into several different pieces, each held by different devices or organizations, so that that full key never exists in a single place. Because that key never exists in one place, MPC removes that single point of failure risk that traditional solutions struggle with, and it makes it really well suited for institutional participants. It also happens to be protocol agnostic, so it works across virtually all blockchains. It supports some dynamic policies. It helps with automated workflows. It's a bit easier to rotate, upgrade, and then to integrate some of the compliance systems that most of the institutional folks will be familiar with into the workflows. So what it effectively does is it delivers that distributed trust without the rigidity of kind of multi-sig and makes it really, I think, the preferred architecture for institutional custody today. Copper then, I think, takes it a little bit of a step further in terms of the solution that we offer. So that includes both a custodial offering and a non-custodial offering. And those are really just defined by how those MPC key shards are distributed and managed, or effectively how they're safe kept. So with the custodial solution, Copper manages the majority of the key shards as kind of the centralized custodian, manages and maintains exclusive possession and control of those key shards. Whereas with the non-custodial solution, Copper and the customer will each manage one key shard, with neither of the parties having what we say is exclusive control over the assets. There's of those two options, we then further kind of offer segregated custody accounts and omnibus custody accounts. The segregated means that it's basically leveraging a dedicated blockchain address for the sole use of a client. And then the Omni really enables some off-chain benefits in terms of speed and cost efficiency. Those account structures are then further customizable in terms of temperature, hot, warm, cold, depending on whether those key shards are held on or offline. That kind of sets the underpinning, I think, for our flagship offering, which is called the Clearloop Network. So we've taken that custodial underpinning and pioneered to maintain the industry-leading off-exchange collateral settlement solution. That's something Alex kind of alluded to earlier today. It's used by some of the largest and most sophisticated industry participants. That includes prop trading shops, prime brokers, qualified custodians. As I think most of the folks participating here are aware, typically the way that it works in the digital asset ecosystem is a trading venue or a centralized exchange will require customers to pre-fund, meaning that those customers actually have to transfer assets to a wallet that's controlled by the trading venue before a customer is actually allowed to trade on that venue. What Clearloop does is, in contrast to that, allows institutional customers and connected trading venues to engage with each other directly through our platform without actually having to transfer those underlying assets out of Copper's custody prior to trade settlement. So you can kind of simply put, think of it as third-party margin seg. Copper customers, of course, maintain a direct bilateral relationship with trading venues. They execute transactions directly on and with the trading venue's order book. But the important component is that assets stay within Copper's custody. They never sit on the exchange. Traders will get a virtual balance on the exchange that they trade on, and that actual settlement will occur pretty frequently across our platform, 1, 2, 4, 24 hours, depending on the exchange itself. And then the exchanges on the other side, importantly, are actually posting collateral into Copper as well to help protect our customers from any P&L exposure that might exist between those very, very tight settlement windows. So the structure really is designed to eliminate the need to pre-fund exchanges. It's been around since 2020, as you can imagine. It took on some increased focus over the course of 2022, as Alex mentioned. And then later in 2022, the major counterparty risks that were highlighted by the FTX collapse. So I think the other really important component of Clearloop to flag is, besides the counterparty risk mitigation benefits for clients who are trading across multiple centralized exchanges or trading venues, it offers some pretty significant capital efficiency benefits because customers don't have to hold multiple pools of capital across different venues. They can deploy one capital pool and then opportunistically be a bit more efficient and protected with some of those idle assets. I think the strength of the Clearloop network is really highlighted by the network participants themselves. So some of the names of the nearly dozen partner exchanges that we have include Coinbase International, OKX, Deribit, Bybit, Date. To give a sense of what that means in real numbers, I think in March alone, we facilitated about 63 million trades across Clearloop, over 100 billion in notional traded volume and about 2.5 billion in gross settlements. So I think all of that, in line with what Alex mentioned earlier, reflects in large part like the depth of liquidity that's available to our customers, and Clearloop's ability to support some high volume capital efficient trading across really any sort of market condition. I think with that as a foundation, very happy to turn over to Copper's Ben Thomas to highlight where our financing desk helps with the execution of some of the Bitcoin treasury ops.
Brilliant. Thanks a lot, Adam. So Alex did a great job right at the start of this presentation, outlining some of the most common strategies that Bitcoin holders utilize today to generate returns. As he mentioned, as part of that presentation, all of those strategies carry some element of risk. So Copper, as an institutional custodian and a collateral manager, provides clients with products and tools to help them mitigate or manage those risks. So I'll take a few minutes at the end of this presentation now just to run you through some of those features. So if we start with lending, again, Alex alluded to this, right? 21, 22, we saw the big blow-ups of all of the major lenders in the space. Everyone's familiar that was largely driven by risks associated with unsecured lending, people not understanding rehypothecation, and generally just a lack of transparency across the market. Despite this, there continues to be demand for lending, both from the lender and the borrower's side. And we've been approached by many clients continually to offer a service that offers a better risk managed way to get back doing these sorts of products. So at the same time, we also saw around 23, 24, and this obviously continues as the market continues to mature. We've witnessed more traditional counterparties enter into the space, and particularly on the lending side, who frankly weren't ready to move from a starting point of zero, coming into crypto and facing smart contracts and the like, and frankly weren't set up or comfortable handling a bearer instrument that trades 24/7. So as a result, around about 16, 18 months ago now, we launched an agency lending service. And the goal was really simple. This is to provide a fully managed loan lifecycle handled by experts that have a combination of experience, several decades across traditional finance and crypto. It was important that the agency product that we offer is not about pooling funds. It's not an earn program. It's not a black box for where the yield comes from. And importantly, it's fully transparent. There's no collateral rehypothecation, and it's risk tailored to every lender's appetite. So Adam explained some of the strengths of Clearloop and the network for off-exchange trading. We've extended that concept further as part of our agency lending offering with the concept of a Clearloop loan. So simply put, this means clients can lend directly into borrowers' Clearloop accounts at Copper. Our financing desk handles everything from the loan origination, trade capture, settlement, through to margin calls, interest collection, and events of default. It's effectively lending without your Bitcoin ever leaving the custodian. Furthermore, on the lender side, I mentioned transparency. We provide full transparency. When our lenders enter the agency program, via our UI, via our APIs, at all times we give them full transparency, who they're lending to, that their loans are in a healthy state, and where those loans are currently held. Alternatively, clients can opt to lend in a more traditional vanilla method away from Clearloop. But importantly, the collateral still continues to always be held by Copper as their agent in a bankruptcy remote wallet, segregated, and we can offer borrowers the ability to post collateral either on a title transfer basis or as a custodian, we can obviously offer a security interest or a pledge of that collateral, knowing that Copper, via its custody composition, can go in and seize those assets in the event of a default in a timely manner. So it made sense to us, to offer this product. Agency lending products have long been an ancillary service offered by traditional custodians. From a lender perspective, it makes sense to outsource loan management to experts that have a network like a custodian would naturally have of both lenders and borrowers on the platform. As I mentioned before, our expertise in doing this and managing this across crypto and traditional markets, and the fact that we have tools to run such a program. So it was a natural progression for Copper as a business to offer that as a service to our clients. You'll see the slide here just outlines the legal framework that supports this, which again was, a robust legal framework is fundamental to all of our products from the agency lending perspective. We're all working towards a vision where eventually the likes of lending through digital assets can largely be algo and RFQ driven and fully automated. And we'll get there eventually, I'm sure. But we felt from a starting point, given where the market is and given some of the scars from, say, those blow-ups in 21 and 22, it was a jump too far for many of the treasury managers that we saw. And so we've relied on documentation such as the JIMLA 2010, which is kind of a standard borrowed doc in the traditional space, as a starting point for our agency loans. Using a framework that's battle tested, familiar to many, allowed many of our clients to build trust in the setup and get comfortable with the product. So the way these documents work, the treasury managers sign our crypto asset agency lending agreement. This defines the risk framework. This goes back to what I said shortly ago with regards to we tailor this specifically for every lender. It's unique to them, their needs, their risk appetite. It's not a standardized product. So who you face, where and how you face them, it's all contained in that agreement. Any borrowers that they face will be fully KYC, AML checked Copper clients. On a permissioned basis, we facilitate sharing of documentation between lenders and borrowers so they can get comfortable with them, on a bilateral basis, given that ultimately they're underwriting risk against those borrowers. And then the treasury manager will give us under this agreement the discretion to execute a loan program on their behalf with minimal, contact or day-to-day involvement needed from the underlying lender. But importantly, knowing we always operate within the guidelines defined in that agreement and dictated by them. So, for example, should they only want to lend to one delta neutral fund that's tier one in a clear loop loan on an open tenor, absolutely fine. You define it in that document. If you want to deploy your Bitcoin chasing returns with a little more term premium, if it's on offer, that's fine too. It's all just about offering a bespoke choice and then running the program in an efficient but risk controlled manner. On the borrower front, they sign could we just go back? The borrower front sign those other two documents, depending on whether it's a title transfer of collateral or pledge. So that, again, that's what I was talking about based on the global master lending agreement that is familiar globally and, it handles trillions of dollars of traditional security loans every single day. Every borrower, importantly, is on standardized terms. So that ensures from a legal perspective, it's far more scalable. Sign it once, and as long as lenders and borrowers approve one another from a risk perspective, the network of available counterparties that have the ability to face one another quickly grows at speed. We offer the borrowers the ability to transfer that collateral, as I said, title transfer or grant the security interest. That's important. It's important it always sits at Copper, and it's important that we structure our custody arrangement in a way that, in whichever way that collateral is given to the lender, that if there is an event of default, that Copper as the agent can get hold of that collateral as quick as possible, either pass it back in kind or liquidate it on the lender's behalf, whichever route they prefer. But importantly, the collateral never leaves Copper. For more sophisticated clients on the lending front, we also have lending features that are available bilateral self-service model. So if you're more sophisticated and comfortable running a strategy yourself, and you've got established connections, you can use all of our trade capture and collateral management tools within the UI, and again can be run on platform of our APIs and run your own book. So really, this is replacing a lot of the market when I got into it 3.5 years ago, was running loans on spreadsheets and Telegram. That's not a good way to do it. So we're really just trying to bring a more institutional offering for full service loan module to allow clients to tailor anything they want, around margin call settings, cure periods, recalls, invoicing. And there's even optionality if you do want to self-serve to toggle some of those features to outsource the collateral management and the loan servicing to Copper. So give you a very simple example. You've got your own client, your own legal documents. You want to book on Copper's platform. You want to run the loan life cycle, but you want Copper to step in and collect the interest and pass it back every month. That's something you could toggle on as an option that you want to outsource. So again, that's helped clients that don't have necessarily the back office teams to support a crypto lending business, or frankly, do but perhaps work 9 to 5 Monday to Friday and aren't yet a 24/7 365 business like Copper is. So we can shoot on to the next slide now. So that's lending covered. That is hopefully a simple to understand foundational BTC income strategy. But we've also got a suite of other collateral management solutions that are largely centered around that Clearloop product that Adam described as being our main, really what Copper's known for as its flagship product. So we continue to think of we lead the way in off exchange trading, and we just constantly think about how can we leverage that network we've built over what's coming on for 8 years now, an increasing network of venues that sit on top of it to offer unique risk managed products. So Alex covered, for example, covered call strategies is another way that Bitcoin treasury managers seek to generate returns through option premia. There's obviously a whole world of derivative strategies that sit on top of that as well. As far as the covered call piece, he touched on the tail risk of getting taken out of the trade and losing your Bitcoin. That's bad enough. But managers really should give thought to the additional counterparty risks that are present. Either if you're trading on exchange or if you're trading option strategy or a derivative strategy where you're facing an OTC counterpart. So in the case of an OTC dealer, simply not posting collateral to the dealer and relying on their own balance sheet in order to affect the strategy is going to cap the size of trades that you can do. And kill the spreads on most trades, frankly. We've seen some people rely on simple tri-party structures, segregated assets at the custodian with a security agreement for derivative strategies. And absolutely, Copper's got the tools and legal docs to support that option. But these are also expensive, given the collateral needs to sit locked and is unusable for the derivatives dealer. So instead, what we've introduced is a restricted OTC collateral management product. So simply, if you go back to the example of a taker trading against an options dealer, you can come on platform, record your collateral requirement, agree that over the platform, post and lock it for your counterpart, and handle all the standard post-trade lifecycle events. But importantly, your OTC dealer receives the collateral he needs to hedge that derivative, but it's locked, much like a Clearloop loan, it's locked into Copper. It's locked at the custodian. So the collateral's only available for the use case it's meant for, which is hedging your derivatives position. So you can be sure bad actors cannot rehypothecate your collateral outside of Clearloop or Copper, and they can't put your assets at risk by putting them on exchange. We have supporting security agreements and account control agreements that give additional comfort to those posting the collateral that in the event of an OTC dealer insolvency, you've additionally got a lien of their assets that are held in the Clearloop account. So importantly, you've got that protection from the exchange. If the dealer goes under, you're not in a queue with the administrator for, again, as Alex said, you're not there alongside his mum for the next 3 years hoping to get some of your money back because you've got that explicit lien. Alternatively, if you're comfortable running those derivative strategies directly on it or directly with the exchange yourselves and not needing a third party, then obviously do that through Clearloop and take away the counterparty risk. And then a final thing before we turn it over to questions, just on the right side, you'll see basis trading, and really this could extend to basis trading or any sort of perp funding arbitrage. Obviously, incredibly popular in our industry as another means to chase returns on Bitcoin. And this is really where we see our product suite stitched together neatly as a one-stop service provider that helps our clients manage risk, optimize their returns. So you seed the manager with Bitcoin, knowing the funds sit there in Clearloop. It's insolvency remote, no Copper risk, no exchange risk. So all protected from a standard institutional custody setup. You're then running whatever strategies you're running across a network of exchanges with 90 millisecond off-chain movements to move collateral across additional trading venues with ease. That's obviously going to allow the manager running that strategy to optimize their returns. Again, Alex talked about cross exchange strategies that they run over at 2 Prime. You've then got access to the agency lending desk if that Bitcoin needs to be converted into USD stable coins to run a basis trade strategy, for example. That can all be done as a one-stop shop. With the benefit of our deep pool of lenders and stickier interest rates to borrow than you might otherwise get from exchange loans or DeFi. And then finally, as Adam said, there's an OTC desk. If you're generating P&L that's out of Bitcoin but paying back to your end client in Bitcoin, the trading desk allows you to convert that P&L, and then you can layer the account control agreements and security arrangements over the top to give that additional protection and security interest where required. So really, I guess in summary, hopefully that gives you a few ideas how an institutional custodian can serve as a foundation to running safer and more efficient Bitcoin strategies. But it's really just offering that full product suite to allow people to, as Alex said right at the start, know your risk, know your counterpart, and you need to take risks to generate returns. But this hopefully allows you to do it in an optimized fashion. So that's all from me. I think we'll hand over now if there's any questions from any of the listeners.
Well, I would just say, yeah, if you want to get in touch with the Copper Two Primes teams, you can email these general emails here. I think I know at least Adam and I will be out in Vegas next week at Bitcoin Vegas, and I'll be at Consensus Miami as well. So please do reach out. We're happy to meet. You don't have to deal with both of us at the same time. Just one at a time at least. But yeah, I don't know if there are any questions. I don't see any questions, but could give a couple seconds. Um, Otherwise, yeah, I think that, in short, there's a lot of ways to lose Bitcoin, and there's a few to gain it with some risk involved, is maybe the bleak picture. Technology like Coppers can mitigate a lot of the counterparty risks and many others from what they've shared. And we can trade it and hopefully try our best to grow it into more Bitcoin. But I just hope there's a clear-eyed view of the risks involved, especially as the asset becomes more and more valuable over time. So with that, yeah, I don't see any questions. Oh, I do. I saw a question. Hold on. We've got one. Bitcoin mining is the only source of native Bitcoin yield. Thoughts? Um, well, again, you can lose money Bitcoin mining. There's inputs like the miners themselves, energy costs, the facility costs, and depending on the price of Bitcoin, it could be negative yield. And so this is a trade like any other trade. Like you're taking risks on a bunch of different prices of different things and trying to hope that you can create the Bitcoin for less than it costs to make. The miners themselves could go stop working, better miners can come out. You could have a power outage, which I know some public miners have had at times. So again, in the sense of a risk-free return for the time value of money, no, I don't think that I would call that yield, but it is one way to make a return. I think actually one of the hardest, most competitive ways at this point and at this price. So that would be my answer on that. Um, I don't know, Adam, any opinions on Bitcoin mining as a source of yield?
No, I tend to agree. I would consider it creation, not yield.
Yeah. Like if you were like a gold miner, like going into the gold, you wouldn't say, "Oh, we're generating gold yield." You're just mining gold. Um, let's see if there's anything else. I think that's it. So, well, I'm glad we had one question. At least I know someone was listening about something. Well, I really appreciate it, Adam and Ben. It was great speaking with you. And I hope you have a good rest of your day, everybody. Thanks.
Always. Thanks, everyone.
Thanks, guys.